Hello, everybody. Welcome to Tuesday. The S&P 500 was down almost 0.7% today. It was down actually quite a bit more at one point in time, so it did kind of rally up towards the end of the day. But it seems to be that it was down because after the market closed on Friday, they ruled that the tariffs, the majority of the tariffs, about 78% of tariffs that were done under this emergency decree were not legal. And it was, the bond market looked at that and said, wow, we've been getting revenue coming in from these tariffs. If we don't have that revenue, the deficit's going to be, higher, going to have to sell more bonds. So the bond market fell, which makes the yields go up. And so, for example, almost a 5% yield on a 30-year treasury. And so when yields get higher, it just becomes a competitive marketplace for stocks. Stocks average 11%. If you could get 8 or 9%, just for example, on a treasury bond, which is much more safe in terms of its guarantees, you're probably going to buy the treasury bond. And so that there's always that kind of competition that goes on between all these different asset classes. um, and so what happened was that the kind of interesting in this, situation, that the International Trade Court already ruled these illegal. And so this is the, appeals process, 11 members on this particular panel, judges. And so seven of the judges voted that it was illegal. And really interesting because what's happened is that Congress allowed the president to regulate imports in an emergency situation. And so most of the talk has been about whether this is really an emergency. And so they're talking about how it's an emergency because of these trade deficits. And most people look at that and don't see trade deficits as an emergency. But the court ruled that that actually didn't give the president the ability to do tariffs at all. It gave the ability to regulate imports. And so obviously the White House is looking at that and saying, well, that gives us the ability to do tariffs, and court's saying no. If you think about it, it makes some sense. That, for example, the SEC is able to regulate securities and regulate, the different things that happens around earning reports and those types of things. But just because they're given the ability to regulate those things doesn't give them the ability to tax. Congress has the ability to tax. And so they actually kind of attacked it at its core basis, not so much whether these things are really emergencies, but the fact that, that tariffs aren't included in this particular situation. So again, 78% of the tariff revenue that's been coming in has been under this emergency declaration. And now the courts are saying that's not going to be, something that's allowed. So of course, now it's going to roll up to the Supreme Court, and we'll find out what happens there. But interestingly enough, they probably need a resolution as soon as possible. There is a requirement that if this is continued to all the way through the Supreme Court to be illegal, they have to refund the money plus interest to this. Now, one thing that did come out of the appeals court, there was two companies that were suing for this. They did ask the lower court to determine whether this applies to all companies or just these two companies, which would be a big deal. However, I think if they can get it to apply to two companies, somebody could go back in there and stretch it to all companies because there probably isn't much difference. So, we'll see what happens there. But that's, really fascinating. Now, there are other ways for the president to do tariffs. They're just a bit more restrictive and a little bit harder to get leverage on, kind of like they've been doing now. So, for example, these what I would call line item tariffs. So, steel, aluminum, copper are great examples. We've got a 50% tariffs on those. And we've talked about tariffs on pharmaceuticals and semiconductors and those types of things. That is something that the president is allowed to do. It's a bit more complicated. It takes longer for them to take effect and what have you, too. So, that's kind of I think that's plan B if this doesn't go through. But it is interesting that the market actually dropped because the market dropped because of tariffs in April, and now the markets may be dropping because of the fact that we won't have tariffs today. So kind of weird how that works. But in between now and April, basically the bond market is kind of settled into this concept of having this excess revenue. And the bond market really shouldn't. I mean, if you look at the history of tariffs, especially at this level, we're at almost 19% average annual tariff. Look back to the 1800s, and you'll see when it gets up this high, it doesn't stay there. It comes back down because it doesn't work at these levels. So, and I've been saying that for a while. And there might be some level that it does work at. Maybe they could find that. But if they're not allowed to do these types of tariffs, they're going to have to go around and look at these situations where they come after these line items. The problem with the line items is it's harder to negotiate. I mean, you can go directly to the EU or China or Japan or wherever it is and negotiate what your tariff's going to be. How do you deal with it for industries? Across the boards, and how do you figure that out? You're basically just assigning these tariffs, as far as I'm concerned, and not really having these, ongoing negotiations. It takes away the whole leverage aspect that I think the White House likes here. So, we'll see how this plays out as far as that goes. But interesting day to see how the market reacted to all of these different things. I think we'll need to play this out a bit. Of course, the dip buyers came back in, drove it up. I saw it down about 1.3% at one point in time. So drove it back up to, just a little bit less than 0.7% on the downside. And again, until you start to have more erosion, you're going to continue to have maybe some volatility, but a lot of dip buyers coming in, kind of supporting stuff. If you look at what's going on, the institutional buyers have been buying less and less throughout the year, and the retail buyers are buying more and more throughout the year. So this is being run by retail investors who, maybe don't have the perspective of how this might work and how it works in 2008, how it worked in 1929, what happened with tariffs, those types of things, playing the momentum. Hard to blame them. That's why we're still 2/3 of the way in with our stock market exposure, just because the momentum is still to the upside and the dip buyers are still there. And so, the market mechanisms are still, pretty strong as far as that goes. The concern is really just, is an erosion situation happening with tariffs, deportations, and independence of the Fed. Is that enough to kind of create problems? So even though the positives like rate cuts and AI trade and those types of things get weighed out. So that's what we're waiting to see how that's going to play out. But anyway, look forward to being able to talk to you again tomorrow. Thank you.